Hi, I'm Jim. Today's video will give you an introduction to modern retirement modelling and the improvements that have been made in the way uncertainty gets handled in models. I'm a qualified actuary with 30 years experience working with superannuation funds, advice groups, insurance companies, banks and software firms. The type of models we're talking about today are called stochastic, and I'll walk you through an example of how it all applies to a 67-year-old couple with $450,000 saved for their retirement. One of the main aspects of stochastic modelling is the way it deals with unknowns. So some of the key unknowns in retirement are how long your superannuation has to last, which is based on your life expectancy, and what investment returns could be. So older style retirement calculators took those as inputs. So they had to take an assumption for how long you're going to live and an assumption of what your investment returns will be. Whereas a stochastic model, it does that for you. And the way it does it is by testing thousands of plausible scenarios for what these unknowns might be. But all these scenarios are weighted by the probability that each one could occur. Here are some typical results from a normal retirement calculator. In this example, it's a couple who want to spend $62,562 per annum, which at the time is the As for Comfortable lifestyle. You can see that the amount they need to save to achieve that lifestyle, which is these figures in the table, varies depending on what their investment returns will be, which are these figures across the top, and by how long they think their superannuation needs to last. So if we think about a couple of extreme scenarios, if they earned 7% as their return year on year, and their superannuation needed to last 25 years, then they may only need, say, $540,000 saved up to achieve that lifestyle for that time frame. Whereas if they only earn 2% per annum, and their super needed to last for 35 years, and they didn't get any age pension, then the figure they'd need to save to achieve that As for Comfortable lifestyle, the model spits out as $2.97 million. So you can see what an extreme range it could be, depending on what you put in for these assumptions. As you face retirement, there are some really key unknowns. So on the horizontal axis here, we're looking at the range of lifespan events that can occur. So in effect, it's how long you might live. So someone might enter retirement and not live for long. They could get hit by a bus. They might live exactly to their life expectancy. But you could have scenarios where a couple both live to age 95 or more. And in the extreme scenarios, there will be some people retiring today where at least one of them in a couple might last to age 105 or even more. On the vertical axis here, we're talking about investment scenarios. So a household might retire and enjoy good investment returns followed by low inflation for the rest of their life. I mean, that would be fantastic. But it's also possible that someone could retire and experience a stock market crash soon afterwards, followed by very high inflation. As a retiree, you really need to feel confident that you'll be okay in all of these scenarios. What we're showing here is kind of a heat map. The red shading indicates the scenarios that are more likely to happen, and the blue scenarios are things that are less likely to happen, but still could. So your dark blue are the kind of extremes. So down the bottom right here is scenarios where you live a very long time and market returns are really poor. Whereas the dot in the middle is people living to life expectancies and getting average returns. A stochastic model stress tests all of them. So these models can take into account the scenario you're in, so the person's age and the age of their spouse. It can take into account health and obviously life expectancy and uncertainty around that. It can also model things like someone's future earnings. So if someone's working part-time or if they haven't retired yet. Obviously, it takes into account their current wealth, so current superannuation for each person, any non-superannuation savings they've got, like investment properties and things like cash and personal assets. You can also model decisions a person might make, the big one being their retirement date. And as I mentioned, part-time working plans, they might work part-time for a short period or a longer period. It can also take into account their allocation to different types of investments. So the highest level, it's growth assets versus defensive assets. So growth assets would be things like shares and property. Defensive assets is things like term deposits, cash, government bonds. But then on the right, we're talking about the external factors. So obviously the means tested age pension can be taken into account. Investment income from all these investment returns, inflation, otherwise known as cost of living increases, and tax. Just a disclaimer, everything in this video is not financial product advice. It's vital to distinguish between a financial calculator's results and financial product advice. So the regulatory definition of financial advice focuses on product advice, which is advice on what someone should do about a particular investment or financial product or a category of financial products. So only a licensed financial planner can give financial product advice. Whereas a financial calculator can help inform you about long-term outcomes from your current situation and specific decisions you plan to make. But before deciding on which products to use, you should consider taking advice from a licensed advisor. So let's talk through an example. In this example, it's a fairly simple case study. So husband and wife, they're both aged 67. They're in average health and they are already retired. They've got a primary residence worth $1 million. They've got some personal assets, so things like a car and furniture, worth $30,000. And his superannuation is worth $250,000 and hers is $200,000. So the total net wealth is $1.48 million. The projection we're going to do starts with their current retirement assets, so that $1.48 million. We've assumed a balanced risk profile, so that's someone with an account-based pension with 60% in growth assets. It assumes they never sell their home, so in all scenarios it assumes they keep living in their current home. For the cash flow, the model really focuses on what they're going to spend each year in retirement. So it assumes they're going to set a fixed budget and save any surplus income that they might see. But if there's a deficit, it assumes they spend their non-superannuation first to make up that lifestyle. If they run out of their non-super, it then assumes they'll take additional withdrawals from their superannuation to reach that lifestyle. The model allows for any age pension, subject to means testing. So sometimes people enter retirement and they don't initially get an age pension. They might have too much money. But during the course of retirement, as they consume their wealth, the age pension may kick in and even end up with a full age pension. So the model handles that in the background. Now I want to introduce two really important concepts with stochastic modelling. So the first is your safe spending amount. And what we mean here is the amount they can spend in retirement for the rest of their life linked to inflation and have 95% confidence that that's going to last the rest of their life. So basically it's the lifestyle they can have and be 95% sure they're not going to run out of money. Then we've got variable spending. So variable spending is a budget for what they can probably spend on average in addition to the safe level. So the variable spending amount relies on markets doing well, but they have to be prepared to forfeit this if market performance was poor. So an easy way to understand this It's almost like when you're working, you've got your base salary and your bonus. So the base salary is pretty dependable, and the bonus, may or may not happen. It's a good way to look at this concept. So then this stochastic model we're going to walk through, we're using institutional type market assumptions. We work with a company called 10E24. They specialise in an economic scenario generator. It's a model of the world's economies, looking at all the different asset classes and the way they interact with each other. So it really focuses on inflation, firstly, so consumer price inflation and wage inflation. In this table, we're breaking things down over looking at the average assumptions for the next 10 years versus the longer term assumptions. So here, the table just gives you a snapshot of the midpoint assumptions for this model. In the background, it's simulating thousands of possible sequences of what they all might do in the future, but this is showing the average. So the model, it is looking at a post-COVID economy. We've had large fiscal stimulus into the economy, but there's still a significant uncertainty in how things are going to play out. There's a high chance interest rates rise and continue to do so, and a high risk of inflation, which can harm the returns you get from shares and bonds. Now, before we get into the detail of how the modelling is done, I'm just going to jump straight to the main results. Once we run the numbers, this couple have a safe spending amount of $51,000 per annum. So that's the amount they can spend and have 95% confidence that their money won't run out in retirement. The figure includes their age pension, any amounts they draw out of superannuation, investment returns, and it does take account of inflation over time. So that figure of $51,000 per annum, it's been calculated in a way that as prices increase, it would increase too. On top of that is the variable spending amount. So that's the amount they might hope to spend if markets do well, but if markets don't do well, they've got to be willing to forfeit that amount. And the figure here is $8,500 per annum. So on average, they might expect to spend $59,500 per annum for the rest of their lives, but a portion of that depends on market performance and would need to be reined in if things aren't going well, leaving them with the safe spending amount of $51,000 per annum. Okay, now let's get into the detail. And we're going to do this assuming they only spend $50,000 per annum for life. We've been a tiny bit conservative by rounding that down. So this is the year-by-year cash flow chart. And what it's showing is the horizontal axis is how many years they are into retirement. The vertical axis is dollars per annum, and the figures, the colours, are also showing where their income comes from. So the grey area is showing their age pension income, which initially is subject to a little bit of means testing, but over time looks like they get the full age pension. The green line is showing how much they draw from superannuation, drawing the account-based pension minimums. And the yellow dots are showing what's their target spending level or their budget in this scenario. So as you can see, if they spend $50,000 per annum and earn average assumptions, which is what this chart's based on, then it looks like they'll have more than enough income from the age pension and superannuation to pay the bills for life. We assume that if one of them passes away, then obviously the age pension reduces, but we also assume their spending would reduce by 30%. So all that's taken into account in the model. This is just one scenario of thousands that we do, just to give you a flavour of what's going on and all the components of what's being modelled. Now this one's the wealth illustration. And again, the horizontal line is showing how many years they are into retirement. But here, what the chart is showing is the different assets they've got. So what's the value of all their house and superannuation and cash and any shares they buy? So the grey is showing the value of their home, which, as we saw, was $1 million now. The model assumes, our average assumption is that properties don't quite keep pace with inflation for the next, say, 7 years. But after that, properties revert to their normal type assumptions and do pretty well. All the figures in our charts are shown in today's purchasing power. It's today's dollars, if you like. The red is showing the value of their superannuation. As they spend their superannuation, the balance goes down over time. But if they're only spending $50,000 per annum, then it's unlikely that they'd run out all the way through retirement. The green and the blue are showing that any surplus income that they've got coming in from super and the age pension that they don't spend is assumed to be saved. So the green is cash and the blue is other non-superannuation assets that they might accumulate over time. But now we're going to start looking at the stress testing that we do. So here the coloured chart is showing the range of what their superannuation balance might be over time. So they start retirement with a balance of $450,000, and dark green line in the middle is broadly the midpoint of what their balance might be year by year by year. But the coloured shading indicates where their balance might be. So we don't know exactly where it'll be because no one can predict markets with full accuracy, but we're fairly certain it'll be somewhere in that range. So the pink area is obviously the poor market outcomes. So that's when markets haven't done well or inflation takes off. The dark green are the fantastic scenarios. That's where market performance has been terrific and probably inflation fairly low. There's a 5% chance that their balance might go even higher than this shaded area, and a 5% chance that their balance could fall below the shaded area. And in the modelling we do, what we're most interested in managing is this point where it might run out. So we want the minimum chance of seeing someone's money run out while they're still alive. So it's looking at the probability of poor scenarios, and it's also looking at the probability that one of the couple are still alive at that point. So this is what's going on in the stochastic model. This is now total wealth, and it's the same type concept as before, but what we're looking at is all their assets. So they enter retirement with about just under $1.5 million, including their home, and the coloured area is showing a projection of where their total wealth might be over time. And again, the pink shading is showing the poor market outcomes, the dark green is showing the really good market outcomes, and we're fairly confident that their total wealth will be somewhere within that range over time. It's quite clear that the bulk of their money is in their home, and the model assumes they never sell their home. So even in these low scenarios, at the bottom of the pink area, they've still got their home. So this can give people a lot of confidence that they can set up a budget for retirement and manage the risk that things could go wrong. So just to recap, their safe spending is $51,000 per annum, and that's the amount they can spend for the rest of their life with 95% confidence. On top of that, they might hope to spend more, but that relies on market performance being okay. So based on average market performance, they might be able to spend another $8,500 per annum. But they need to be able to manage their lifestyle so that if things go wrong, they forfeit that extra $8,500, making an overall total of $59,500 on average. Everyone's life and financial circumstances are different, so your modelling will differ from what we've just seen today. This is important because rather than relying on generic inputs, you need to consider your own circumstances and choices. For example, if the two spouses are a different age to each other, then that impacts when they can access their superannuation. It impacts when they become eligible for an age pension, and it can impact when each person's employment earnings stop, as the other person's employment earnings might continue and end at a different time. All these factors provide different cash flow shapes, and your cash flow scenarios relate to your own options and your choices about how you live in retirement. To underline the need to model your own safe spending level, rather than relying on a generic outcome, let's consider a few other important variables. Many people want to consciously spend more in the early years of retirement while they're most healthy and active, and consciously let that reduce once they reach an older age. They might want to spend, say, $20,000 per year more during their 60s and 70s and let that drop, say, in their mid to late 70s. To do that, they'll need to budget for that sort of variable spending shape, but still be confident that they have enough money for the long term. Another common choice people make is to work part-time as they enter retirement. They might stop their main full-time job, but continue with an element of part-time work. It's often not about the money, that extra income helps, but more often it's about feeling they have value to offer and can enjoy the social interaction of the workplace. For this sort of retirement plan, they'd be drawing down less on their own assets, and that makes quite a difference to their safe spending figure long term. You need to also think about life expectancy. It's not always easy to talk about, but the results are different depending on your health status. People of above average health tend to live longer, so their safe spending level needs to account for a few additional years of expected lifespan. We can carefully calibrate the safe spending level to account for health status. Likewise, we can provide different numbers for someone whose life expectancy may not be as long, allowing them to fully enjoy their retirement as they wish. Inheritance. This is something that some people are expecting to receive after they retire. We tend to include it only if the inheritance is imminent, i.e. it's something they know they're going to receive in the short term. Receiving an inheritance will boost the amount of assets that a retired household has, and this means they can spend more right from the start of their retirement because they know their assets are going to be topped up. The model can take all that into account. The other side of inheritance is when someone wants to consciously leave a set amount for their own children. Here we can calculate their safe spending figure in a way that ensures that when they pass away, there'll be a minimum level of assets that can go to their children. So this can be calculated in a way that lets them live a safe retirement plan and still meet their goals. What about lump sums? The most common example of a lump sum coming in is when someone is selling a business. There's a big cash injection. The flip side of this is outgoing lump sums. Do you want to travel? Those big, beautiful caravans and the cars to tow them can cost serious dollars and reduce your asset base. But when the numbers are done, many people can afford them. Again, we can factor these choices into the models. Another point to make about individual differences is people's investment choices. The safe spending projections will be different for people who invest in very cautious assets. The case study we just looked at was assuming they invest in a balanced portfolio, but a cautious investment mix would get different outcomes, as would a high-risk asset mix. All these factors can be modelled to provide safe spending results based on your choices. The variables or choices go on. Changes to the age pension rules and the income from it. Downsizing or buying a new home, and more. Hopefully this has illustrated that your own retirement circumstances and your choices are not the same as everyone else. So we've purposely built a model based on around all these variables, rather than something that makes broad assumptions and produces results that aren't really helpful to many people. You've seen those sorts of retirement calculators. They have inputs where you plug in your income, your amount of super, when you want to retire and how much you want to spend, and so on. The problem is the hard questions are left to you. It asks you how much you want to spend, rather than the other way around. And this is the entire problem. You don't always know, and getting it wrong can risk not having the life that you wanted. Do you limit your spending when you could in fact have a great lifestyle? Or do you overspend and end up living your later years without the money you thought you'd have? Modern retirement modelling helps remove the guesswork. You tell us your circumstances and choices, and we can determine what your safe spending number will be. We then test and test again, and make sure your numbers are solid. Numbers you can plan around. This can all be done without selling you any investment products or telling you where to put your money. We instead tell you with confidence what your retirement can look like based on your current investments. So if you're approaching retirement, now's the time to know what your safe spending level is. It could just change your life. My name's Jim Hennington, and our service called Jubilation can help you. Our contact details are below. Thanks for your time.